Hi, Dean Jenkins with FollowMeTrades.com, and I have a few questions. So I'm showing the S&P 500 daily chart here, and we had the news of the vaccine, and that drove a run up into the market into new highs. We've been channeling and just flirting with new highs, but not really. Kind of the momentum has died and it's going sideways. If we look at the Dow, I'll use the Diamond ETF here. The Dow did nose over 30,000 and then pulled back just a little bit. And so, the market, the latest move, was based on the, the election results and then the vaccine news. And the vaccine news definitely is good news. But as the market approaches some new highs and a pretty impressive run up since the huge drop when the coronavirus hit, it raised a few questions for me. And most of you know I am a technical trader. I focus on trading patterns, and I think in the short term swing trading, that's really effective. But I don't mind taking a peek at fundamental data. And I'm going to do that real quick here. We're going to look at some interesting fundamental data on the market, and that's where my questions come from. Now, I am not an economist, but I do have a business degree, and I do understand, some simple things, and I'm a simple guy. So what I'm showing here is a chart of the S&P 500 price to earnings ratio, and that's this blue line, versus U.S. GDP, gross domestic product, all economic output of the United States. This dashed red line is the average S&P 500 price to earnings ratio. Now, if you don't understand that number, price to earnings ratio, it's really simple. It's the price of a stock divided by its earnings. So if a stock is $25 per share and their earnings are $1 per share, they have a PE ratio of 25. PE ratio, right? Every company is a little bit different, but this is for the entire S&P 500. And right now, you can see the PE ratio for the S&P 500 is in 36, 37. And this red dashed red line is the average for the last 2 years. And historically, that's about right. Over the last decade or two, about 25, just under 25 PE ratio is the average for the S&P. And here we are at 36, 37. These bars are error bars, one standard deviation, and you can see it moves away from the mean but then reverts back to it. And so price to earnings ratio, the market prices stocks based on what they think the future earnings are going to be. And so when you look at this historically very, very high PE ratio for the S&P 500, that that says that there's a very high degree of optimism that earnings in the S&P 500 are going to grow, right? And when we look at gross domestic product, the entire economic output of the U.S., you can see, their data lags a little bit. But, from the beginning of the pandemic till now, it's come up a little bit, but kind of to historic levels. There's no big uptake in GDP. So you have to wonder, and this is the beginning of my question, right? What justifies a very high, historically high PE ratio in the S&P 500? Because earnings have to come up dramatically at these prices, right? So if the prices stay the same and earnings come up, then the price to earnings ratio will come back here. So that's one thing that could bring the PE ratio back to historical norms, is simply earnings dramatically increasing. The other thing that could bring the PE ratio back to the historical mean would be what? A decrease in price. So stock prices coming down. So when we look at GDP, economic output, without a significant spike, what do you think is more probable? Earnings going up or prices coming down? Let me add some more data. So the second chart I add in, we've still got the S&P 500 PE ratio, the error bars, GDP. I've added unemployment and this blue line. And so unemployment, of course, spiked when the coronavirus hit. It's been coming down, but it's still above, a very consistent historical average. And this is consumer confidence, the purple line. So the consumer is 2/3 of the U.S. economy. And so consumer confidence drives, consumers are confident about the future, about their economic prospects, they spend more money. It tanked when the coronavirus hit. It's crept up and now it's turning back down because we got rollbacks and, spikes in new cases and some uncertainty. So if consumer confidence is not heading up, not driving GDP, what do you think is going to cause the PE ratio to revert to historical means? Earnings going up or prices coming down? I'll leave that question for you to answer. But we go back to the chart. We got some all-time highs. We got a lot of momentum. We're in a channel here. You can probably read my verbal body English about what I think is going to happen next. Because I think these price levels and this PE ratio are somewhat unjustified. So, I'm not going to go short just based on that, but it's important to have some backdrop and be prepared. If the reversion to the PE historical averages is from a price drop, we want to be prepared. We want to trade and profit from that. So that's my insight for this week. Don't have a crystal ball, don't know what it's going to do, but hopefully you find that helpful. I'm waiting for technical triggers and setups, and in fact, most of my trades right now are long because why? Well, the market's going up, right? But when they turn, we'll take our profit and get out. Let me know what you think. Post a couple comments, questions. Disagree with me, agree with me. Love to hear from you. All right, thanks.